Thank you. Thank you very much. Okay, so a few minutes late on the debt and equity discussion, but I would like to take a moment to introduce your moderator, Manuel de Zárraga, Manny, okay, Executive Managing Director of HFF in Miami. So I will go ahead and turn it over to you. Thank you very much.
Okay, thank you very much. And this is my first UF conference, very impressive. Congrats to you Gators. We have a great panel here following the prior panel of NFL players. We have a couple of former NBA point guards joining us here. So I'd like to introduce each of these point guards. And so first, Tom Zale, he's Managing Director of Northwestern Mutual. Then we have to his left, Rich Highfield, Starwood Mortgage Capital, and a proud Gator on this panel. Jonathan Paul with Wheelock Street Capital, and James Norton with BB&T. I'm not going to go through their bios because you have them all here, so you can enjoy reading through that. I'd like to, before we get started, just have a show of hands of all those that here that are looking or have borrowed money for a commercial real estate project or would like to borrow money in the next 12 months. Show of hands. Excellent, excellent. And now a show of hands, those that would have secured equity capital or would like to secure equity capital in the next 12 months. Excellent, thank you. Okay, now everybody with HFF, raise your hand. If you want to meet any of these guys, you have to go through one of the guys here from HFF. So anyway, thank you for joining us. So let's get started on the panel. And what I'd like to do is ask each of the panelists to give an overview of their firm, but really focus on how they're putting money out. And if they're putting more money out or less money out than last year. And what is the, just a little overview in terms of structure. So why don't we start with Tom? So Tom.
Thanks. Hi, I'm Tom Zale. I've been with Northwestern Mutual for about 18 years, and for the last year and a half, I've been responsible for mortgage production for the eastern half of the country. And the prior 6 years, I was responsible for our equity production nationally. So the mortgage portfolio, it stands at about $26 billion today, and the equity portfolio stands at about $7 billion. With respect to the mortgage side, we continue to be very active. We're Northwestern Mutual, it's a mutual company, so one of the blessings we have is we have one client, which is our general account, and we always, knock on wood, have money to invest, so we're always in the market. Last year, we invested over $5 billion in whole loans, and equity was a little bit slower. We were at about $800 million last year, but that was coming off of 3 years where we put out about $1 billion a year each in new equity production as we rebuilt our equity portfolio.
Thanks. Rich?
So it's Rich Highfield with Starwood Mortgage Capital. As the name would suggest, we're owned by Starwood Property Trust, publicly traded REIT. Our company is actually housed underneath L&R Property. Some of you may know L&R, the largest special servicer, first or second, in the CMBS business. 2011, May of 2011 is when our group started. L&R had been buying B pieces, which most of you know the parlance, but B piece buyer, special servicer are somewhat synonymous. Started an origination shop primarily for a typical 10-year fixed rate, traditional sort of CMBS. A small shop, but important to most of you probably. We've been in the business, all of us collectively have worked together for 15, 20 years between B of A, Wachovia, Deutsche Bank, sort of fraternities, if you will. The BP side, we sort of eat our own cooking. You know, we originate loans, typically buy the B piece on the securitization that they're contributed to. In terms of production, again, it's a smaller shop. Last year we were, I always say the top 11 conduit. Guess which number we were? So we were in that sort of top tier of production, $1.5 billion, again, of what I would consider bread and butter conduit deals around 10 million, I think was our average size. Went to market 10 times last year, which is the most sort of impressive number of that. A traditional larger institution like the ones we sort of collectively came from would go to market because they're the largest contributor of fewer numbers of times. But this year we're targeting about 2 billion, and we'll go to market about 12 times. So busy year.
Thanks, Rich. Which frat were you with in UF? Because I understand you're ranked in the top.
That's confidence.
You weren't ranked number 11, I heard on that. So, thanks, Jonathan.
Thanks, Manny. Good afternoon. I'm Jonathan Paul. I'm with Wheelock Street Capital, a company I co-founded back in 2008, which, as you can imagine, was an interesting time to embark on a new investment firm. But fortunately, we've been successful in raising capital and deploying capital. We currently have about $1.4 billion in equity capital under management and have invested in over $2 billion of real estate assets. When my partners and I decided to found the firm, we all had backgrounds at some of the well-recognized large global opportunity funds like Starwood Capital, and for myself, Rockpoint Group and Westbrook Partners, and way back Morgan Stanley Real Estate Fund. And when we put this firm together, we decided to take a slightly different approach to this opportunity fund model, and create something that was a little bit of a hybrid between what in the institutional kind of closed-end space. You hear a lot about allocators who are sort of the traditional opportunity funds who have a very broad mandate and are focusing on taking advantage of distress and other dislocations all over the world and in all product types. And then there's the operator model, which is much more focused, highly selective, is maybe the expert in Washington, D.C. office or Miami condominiums. And we decided to be a hybrid of the two and create an investment model which was still reasonably broad and opportunistic, but was in certain cases vertically integrated in areas where we felt that having our own proprietary expertise would create opportunities to really enhance value add in our investment program. So we have set up currently three investment platforms. The most active to date have been in hospitality, where we've invested in 31 individual assets ranging from higher-end select service, Hilton Garden Inn type property, to sort of full-service branded urban Marriott, Hilton, Starwood product, all the way to luxury boutique. We own a portfolio of high-end luxury hotels in New York City, including we're renovating the old historic Chelsea Hotel in Chelsea. So wide band of stuff in the hospitality space. Another big platform of ours, which is actually based here in Florida, just down the road in Lakeland, is our single-family residential and home building platform. We're now active not only in Florida, where we've done several deals, including a 3,000 lot development we're managing and we're developing in Tampa, Pasco County, but also active in Texas, California, Colorado, Denver primarily, and Raleigh-Durham. In addition, we've got a home builder that's based out of Atlanta. The home builder controls about 5,000 residential lots, and in our core land business, we've purchased about 18,000 residential lots in all those markets we manage. And finally, we recently added another platform in the vertical space, looking to take advantage of what we see as an asset class. It's been a little late in recovering, but is incredibly dynamic and opportunistic in so many ways, and frankly is becoming, as we see more and more mixed use opportunities. We'll probably talk a little bit about the urbanization theme that's ongoing in real estate, and we felt that retail was a great thing to add to our tool set. Now we're also continuing to look to invest in other asset classes. We're primarily doing those through joint ventures. Done some multifamily. We're building, actually got 2 condo developments we're doing in the Naples market today. And we're looking at several office strategies with partners. We'll also do deals in hotel, residential, and retail in the JV form as well. So we continue to be fairly constructive on the overall investment environment today, and I'm sure we'll get an opportunity to get more specific, but we expect to be fairly active, in 2014.
Thanks, Jonathan. And as you can see, Jonathan plays on the equity side. Tom plays on the debt and equity side. And then Rich and James will now speak to us purely on the debt side.
Sure.
James?
Thank you, Manny. I'm James Norton with BB&T Commercial Real Estate. BB&T is a large southeastern regional bank. We're headquartered in Winston-Salem, North Carolina. We're right over $180 billion in assets, 1,800 plus branches, primarily in the southeast. Our banking footprint is pretty much starting in Baltimore, Maryland, down to Key West, over to Texas. We're a traditional financial services, full service banking with consumer, retail, small business, commercial, capital markets, and we've got a large insurance platform. I represent, I guess, if you will, the balance sheet lending for commercial real estate for BB&T. We also own a subsidiary company called Grambridge Real Estate Capital, which is our permanent mortgage brokerage division that places agency debt, life company, CMBS, of the like. So we're extremely active. I think in Florida alone, our different teams without the state of Florida put somewhere between $700 and $800 million in commercial real estate funds out on the table with our developer clients last year, and we're looking to do more this year. We don't really discriminate on property types, particularly income producing. Multifamily is hot, obviously, industrial, office, and residential, single-family residential is becoming a pretty hot topic, and possibly some condos here and there. So,
Great. Thanks, James. We were speaking a little bit prior to starting the panel, and I asked each of them, are you extraordinarily busy? And I think the answer was a resounding yes, right? So it's an amazing time to be in the real estate business, an amazing time in the capital market. So we'd like to hone in a little bit that energy to Florida. And so if you could, each of you, give us a little overview in terms of what markets get you most excited within Florida, what types of deals, properties, and what, in the same regard, what scares the hell out of you? And if you're investing in Florida, what types of structures you're looking to do. So why don't we start? I'm going to start at the end, James. Since you're a banker and you comply with Dodd-Frank, so you like everything.
yeah, well, that's what scares the hell out of me is the Dodd-Frank and the regulatory environment we're in. We were kind of chatting beforehand. We were talking about what's going to separate us going forward as banks and competing with one another, and that's kind of hard to do when you're, pretty much a commoditized business right now. It's or commodity, if you will, where the regulatory pressures are really starting to, build, and you don't know what's going to happen. You close a deal today, what that's going to look like a year from now from a capital classification, and so that's kind of our scary thing right now. But other than that, we're active across the entire state of Florida. I don't think any area necessarily more than the other. I mean, South Florida is its own machine right now. Orlando's doing great from what we can tell. In the Tampa office, so the Gulf Coast is doing very well, and particularly multifamily, single-family residential. So we're pretty bullish on the state right now as a whole.
And none of the markets concern you in Florida?
I mean, sub-markets maybe, but not as a general statement, no.
And condos in Miami, you're bullish?
Me personally, I don't cover Miami. That's a whole different country down there.
You wimped out of that one, boy. Jonathan, you want to give your thanks, James. You want to give your perspective?
Sure. I'd say in general, we also are very positive on the state as a whole and the investment dynamics here. Just given, that obviously the state's rebounded nicely, particularly in the top markets from the recession. We're seeing pretty strong broad-based job growth in most of the major markets. Obviously, the demographic story is very positive here. And supply barriers are, in most markets are real, either whether it's environmentally driven or driven by by the pressure from, you can only go so far before you're in the Everglades or in the ocean. So it's real, unlike some other markets we're in, like Texas, where we really have to pay attention to entry barriers in certain submarkets. Very positive. What markets do we like? I mean, we try to be very focused in what we do and get scale, so we're by definition focusing on the larger markets. We're looking very seriously and have made investments and continue to look in Orlando and Tampa. The housing supply-demand fundamentals are very strong in those markets today, particularly in certain submarkets. I mean, obviously, even back at coming out of 2009, when Florida was one of the many poster children for the housing debacle. And Orlando in and of itself was, ranked pretty highly up there. We were able to find a submarket near Lake Nona where we did one of the first new residential developments that the state saw in this cycle, called Randall Park, just down in the southwest. As many of you probably know, there were 40,000 some odd jobs going into the medical city there. Tremendous shortage of quality finished lots, and the demand in 2010 was high enough to support a fairly healthy margin on a new development deal, and it was one of the first that was done. And it just goes to show you that we still believe, whether you're in the bottom of the cycle or the top, a lot of it still comes down to market by market. A lot of folks looked at the housing market on a national basis and still do, and it's very hard to do. You really need to get down to the granular level. And Tampa, very strong fundamentals. We're doing a development in South Pasco right now. I think we had 17 builders express interest in developing in the project. Terrific fundamentals, and frankly, not as I said earlier, not a great supply of finished lots. So we're positive on that. Miami concerns us. We love Miami because of the demand characteristics. The supply side is something that concerns us, particularly on the condo side. But we expect to be active in Miami, particularly in maybe not in the residential, but in some of in office, industrial, and retail as well. Interestingly, on the condo side, we've made 2 investments in Naples. It's obviously a much smaller market than Miami, and you're not going to see the headlines, but you're also not going to see as many cranes. And we saw that market really tightening up a little over a year ago. In fact, Manny was agent on a distressed land purchase that we bought in downtown Naples. And the margins are fairly compelling with depressed pricing sort of versus the peak. So we see real runway to the upside. But most importantly, we can count on one hand, at most 1.5 hands, the competitive, true sort of Class A condo pads in that market. And this is a market that WCI was delivering 1 a year. Bonita Bay was delivering 1 a year, and there were probably 2 or 3 others going throughout the late 90s and 2000s. So now that and nothing's been delivered since 2008. So you had a complete shutdown. So we love the supply-demand dynamics in that submarket.
And Jonathan, just real quick, what is your targeted IRR on your investments, or generally it's?
It really varies. I mean, in residential land, we're targeting an unlevered, generally looking for unlevered 20s. And what's nice about that business is it can have pretty good duration as well. We know we're not going to get that in in a value-added repositioning in a great market in Miami, which something you might show us, and we'd look to sort of be in the mid-teens to maybe higher or slightly even lower, depending on the risk profile of the deal and the ultimate quality. I think going forward into this phase of the cycle we're in now, we're actually looking to dial back our risk a bit and dial back our returns a bit, but err on quality so that we can, one, ride out a negative, if you're looking to hold something in a 5 to 10 year hold period, we can ride out a downturn. And if things continue to move very positively and capital flows continue, we'll still do just fine.
Great, thanks. Rich, I'm going to skip you because you didn't answer the frac question. So, no, I'm going to come right back to you. So, Tom, you play in the debt and equity side, and Jonathan plays in the equity side. You heard what Jonathan, the markets, I think you're involved in different asset types, different markets. So
Yeah.
give your perspectives.
Sure. Well, actually, I personally play in the debt side 100% now, but we're very active on the equity side. We love multifamily, and coming out of the downturn when I was running the equity program for us, we got in early, and we actually had at one point over 9,000 units under development, and a lot of those are stabilizing right now, which is turning out to be a really good bet. 3 of those projects are in Florida, 2 of them are in South Florida, and 1 is in Tampa. So that is a property type we like. Obviously, we believe in Florida long term. There's some volatility we watch in different markets. We really are careful about site selection. You can talk about markets, but really real estate is you got to look at the fundamentals and the specific site location, relationship to the competitive set, linkages, services, all that kind of stuff. So I hate to say that we would necessarily rule out any market, not necessarily even a secondary or tertiary market, if there's a really good opportunity there. You wanted to talk a little bit about deal structure too. Our typical deal structure, and I see some old partners, including Mr. Terwilliger there, who was one of our earliest multifamily JV partners. The structure hasn't changed that much over 15 years. What is unique about Northwestern is we bring in a construction perm loan, typically sized at about 65% loan to cost, and then we'll bring in up to 90% of the equity. And the construction perm loan is priced at market. We can't really price non-market. The developer partner doesn't really appreciate that. There was a time coming out of the downturn, I think we got a little bit of premium in our construction perm loans, but that's not the case anymore. And then the equity, basically it's a pari passu return to some preferred return level. Typically that's in the 8 to 9% range, and then you get into some promote structures, and we try not to give up more than 30%, above the pari passu level in a promote structure. Other property types that we like is specific to Florida. We've done really well in manufactured housing. We have a guy, John Jacobs, who's basically focused on that practice, and we have a significant manufactured housing mortgage portfolio here, and we have a handful of manufactured housing equities in the state. So that's treated us very well. Outside of that, we're more of your traditional institution. We have a strong appetite for institutional quality real estate. Retail as an equity makes us nervous. Good quality retail that's well located, and especially the fortress malls like Millennia and Aventura malls like that, we love to have a loan on. Office, if it's well located, we like. Industrial we love, but it's really hard to get size. I mean, our average loan size is around $60 million, so we try not to go much below 20, but sometimes we will for the right circumstances. Our loan-to-value range is sub 65%, so that's not too different than our life co-brethren out there.
So, Tom, so Jonathan, somewhere in the upper mid-teens, maybe, equity return. I know you're running the loan portfolio now, but Northwestern, when you invest in an apartment deal, you're looking at what?
They're not that high. I would say, honestly, if you're really honest about CapEx in your apartment pro formas over a 10-year hold, we're probably pro forming an unlevered 7 to 8%, depending on how well located and how much potential rent growth we see in that location.
Right. Okay, thanks. Thanks, Tom. All righty, Rich. Rich, you're in the CMBS business, and your business went from, I don't know, $300 billion into 2007, or 270 billion, to zero in 2009.
Yep.
And so tell us about your business and then Florida a little bit.
So fortunately or unfortunately, depending on your perspective, you know, the market for us, as Manny pointed out, cratered from the lending side. I mentioned we're on the special servicing side too, so the workouts obviously went the opposite direction in 2009 and 10. The origination side, when we started this firm in 2011, I would say, Steve, probably 30, maybe something like that. For 2011, 2012 was probably double. And then we're coming off a year in 13 where it was up close to 100. The prediction for 2014, who knows? I know we're predicting a relatively modest increase in volume. I said we did $1.5 billion last year. We'll do about $2 billion this year, knock on wood. In terms of Florida, I'm biased. I grew up between Orlando and Jacksonville. Obviously went to University of Florida. My wife's from Fort Lauderdale. Our offices are, you know, and our company's based in Miami Beach. So I am inherently bullish for a lot of different reasons. Just the general draw to Florida from a tax standpoint, quality of life, the affordability of most areas, and thus, as sort of the credit guy for our group, you know, there are few or no markets I'd say, geez, I want to stay away from. There are certain pockets, I think, like I think you said, the sort of sub-markets that I'd say are a little concerning, or certain property types that I think, oddly enough, have heated back up over sort of the '07 levels.
Which are?
You know, I would say certain pockets, like I think Miami, as much as I love it, the beach, one of the places that you drive up and down the beach and there's cranes, you know, back.
Cranes are good.
And cranes are good. It's encouraging. I remember when there weren't any. And you know, from a hotel standpoint, that's the one thing that concerns me, is that those things can crush you. But again, the right operator, the right flag, maybe not. So we, like I said, we sort of specialize in, I would say, sort of below your targets. A big boy loan for us is sort of north of 40, and our sweet spot is in that 10 to 12 million, and pretty much any of the markets.
Okay, great. Thank you. There's a lot of capital out there, and it's really tough to. The good thing is there's capital, and I think, like Jonathan was mentioning, you just raised $650 million, and you pretty much capped it out because you could have raised more if you wanted. So to put all this capital out, it's got to be highly competitive. So I asked each of you, how in the heck are you competing to get this capital out? And because it's tough. So I don't know, whoever wants to go first. Tom, you want to?
Sure. Yeah, we still have an appetite, and so does everybody else. So it is very competitive out there. So how does a life company meet the allocation? We're not. I mean, we're competing with all of our other life company brethren, and it seems like our strike zones are very similar. You know, sub 65% loan to value. So what you really have to compete on, candidly, is how do you differentiate yourself? And one way is reputation and service. We have a very strong reputation for a smooth closing process. Being a, you know, we have a level of confidence within the company that allows us to basically follow through on our word. So if we're out in the market and we think we can deliver on something, even though we don't have formal approval, if we get the portfolio manager and the department head on board, we deliver a high level of certainty of execution. And that's something that is a differentiator in the market. Aside from that, then you look for other ways to compete. And one area that we've been competitive in is we have a very good long-standing construction perm loan program where we'll lock rate, prior to construction commencement and hold that rate through the entire loan term. That structure, typically we try to keep it at or below 65% loan to cost going in. That is a differentiator because there aren't a lot of lenders who are going to be willing to lock rate that early. We also have a good construction payments unit in-house, and so we're able to process a fairly decent volume of that.
Great, thanks. James, so on the lender side, how are you competing?
Again, kind of differentiating ourselves from the other, regional or super large banks out there, which is again tough to do when rates are where they are, and the kind of the regulatory environment. Again, it's kind of tough to do a high rate deal in exchange for a higher risk threshold. We're not there, so it's really cutthroat. I'd say a lot of our clients borrow many times a year. Some do 2-3 deals. We have one we've closed probably 50 loans with in the past 12 months, smaller ones, but they're repeat clients. So I guess the big thing for us is relationship and being consistent with our structures of our deals and pricing and all of that sort of stuff. And ease of execution is typically somewhere a bank can compete with a life company or a CMBS in particular, because we're portfolio lenders, and you actually have a warm body to talk to before, during, and after the loans close. So it's kind of where we compete. There's a lot of relationship components to it.
How about non-recourse debt?
What about it?
It's spelled R-E-C-N-O-N.
I don't know. I guess a lot of these real estate developers figured out pretty quickly they'd rather put a little more equity in than sign on the line, and we kind of figured that out too. We'd rather the equity be in up front, and on particularly stabilized assets, it makes a lot more sense than chasing someone down when they're going down a slippery slope. So we are doing non-recourse for stabilized apartments,
Not
industrial.
construction loans, right?
What's that?
Not construction.
No. Well, not we want somebody to sign that they're going to finish and be responsible for the loan until it's built, and then we've done getting creative with ways to limit it and make it go away eventually when you get to a certain risk level in the asset. So when it's stabilized.
Okay, Jonathan, how are you getting your money out? And
Well, on the one hand, I actually like to hear that, given that
Remember
I
that
think
condo deal we're working on in Naples?
Yeah, well, that's well, I like to hear that lenders are still, when it comes to new construction, still being prudent. But I do have a few loans I need you to look at after that we are trying to get finance on some new construction projects. I mean, what we're seeing on the condo side, just as an aside, is we're looking now at deposits of 30 to 40%. Pre-construction, which is pretty significant, obviously, versus where we were at the end of the last cycle, and much lower leverage, going in from a construction basis. But in terms of how we're trying to compete, I mean, I think a lot of this is we're just trying not to do too much. We're trying to be very selective, and that was one of the reasons we kept our fund size. Even though the fundraising market is definitely healthier than it was when we raised our last fund, we felt that our hit rate was going to be a lot lower in this stage of the environment, and we wanted to be able to have, be able to bring our full senior focus onto a deal that we like and really work it and really provide the right service to a JV partner or to a seller and get things done. We've seen a couple phases of this cycle, and I guess it's fairly typical compared to cycles that I've been through in the past. Obviously, first you had the distress buy, where you just buy stuff cheap and hopefully buy good real estate and hope that the world, the economy turns around and assets reflate. That's happened. As value investors, the next thing we focused on was, where can we still buy cheap after the top 5 markets really took off. We saw that there was an arbitrage in sort of markets 6 through 25, where we were getting significant cap rate premiums in a Houston, as an example, even in the best parts of Houston versus a San Francisco. And that's something that we spent a lot of time focusing on over the last several years. Now, unfortunately, I was telling Manny I was reading the HFF sort of 2014 presentation. One of the top themes was that secondary markets are going to be where everyone's moving now. So that we expect that arbitrage to close. And now, frankly, to get our types of returns, we've got to focus on value add, repositioning. We'll still, when we're only looking to put out $200 to $300 million a year of equity capital, we still think we can find on an opportunistic basis just great buys. But they're harder to find, and with so much capital coming into the market. So we're focusing on value add situations with best of class partners, hopefully leverage off our own proprietary platforms. And as I said, we're dialing back our returns a bit in exchange for looking at higher quality markets as a way to compete.
Well, there are tertiary markets after secondary, so. Just
Well,
in case you're wondering.
We're not, that's not part of our plan. I mean, one of the things we've observed when the markets, you get this stage in the cycle, I've seen the biggest mistakes have been raising too much money and taking too much risk to achieve an artificial, to hit that same, whether it's 18, 20% target, you'll go to that tertiary market. You'll put 90% leverage because it's available on. And you're not going to survive the downturn in those situations. So we're sort of looking at it the other way. We love some of the better, more attractive debt that's out there. We'll take advantage of the lower rate maybe rather than the increased proceeds at this stage of the cycle.
Great, thanks. I'm going to jump to another question. I'm going to start with you, Rich. There's a good number of students here, and some of these students would love to be in the capital side of the business, and some may want to be developers. So looking back at your career path, and we can go down the row here, what advice would you give to students in terms of the real estate business and capital and maybe in development? So.
We've actually hired several UF grads, both into our analyst sort of rotation program in Miami and then ultimately into our company. And with me, I would distinguish between a lot of the folks that we get out of UF with some of the qualities that I'd say that are proved to be very valuable to us. And one is, there's an incredible amount of ambition, drive, energy, and intelligence that's not unique just to UF, but also a sense of grounding and not approaching work at a very young age with a sort of, for lack of better terms, a sense of entitlement, or I'm coming out with this degree or this education or this these letters next to my name, but rather I'm coming here to extend my learning from college, and to apply obviously some of that education as well, but the ability to work very hard, very demanding environment, but also interact with colleagues and teammates and not just keep your head down so much that you don't build relationships that ultimately, the older folks like myself in the room would say, geez, that's what ultimately led to opportunities down the road. It wasn't my education as much as that work ethic and the relationships that I built not only at UF but beyond. So.
Good advice. Tom?
Yeah, sure. I have to echo some of that, but also, when I think back when I started, I had a strong appraisal background. I had good fundamentals coming into an institutional environment. And the way it worked for us, you went into underwriting for a period of time, and then you went out to a field office to produce. Well, they did a really good job of teaching us how Northwestern does real estate, but they didn't teach us anything about the relationship side of the business. So I would say that it's really important to work on the relationship side. I think it's even more important now because when I look at some of the analysts that come in now, even when it comes to doing market research, they're so relying on the internet and what they can glean, through different media sources, social media, whatnot, and they're almost avoiding the personal conversations. And I actually had to talk to an individual and tell him, "You're going to go, please, to this market, and go to each competitive property, and you're going to interview the property managers and find out what you can learn. I can give you a handful of questions, but ask questions and see what comes from those questions. That's an art, really, and it's something that people need to realize. I mean, it's still a people business, and you know, when you make that personal connection, you're going to get a lot more information out of somebody. It can lead to more business. It's going to develop relationships that result into more business in the future. So that's I guess an add-on to some of the other things I've heard.
Wise words. James?
I think they pretty much summed it up. I mean, I think coming out of school, and I talked to some of these the students as well, and not too many of them want to do what I do for a living. I don't know why. It's kind of boring, but most of them want to go straight into real estate development or capital markets equity, which you know, I think all of those industries, or even in the brokerage business or legal business, it really just boils down to hard work. Any of those professions I just named, the most successful people in those industries work their ass off, and that's what you have to do. Day in, day out, it's a grind. It's a high-risk business, high reward, very capital-intensive, and there's no other way around. I mean, hard work's going to get you where you need to be, no matter which field you go in out of this program. So,
Great, thanks. And Jonathan, you started your own company, your own fund. You started investment banking and then created your own fund. So maybe give your perspectives.
Sure. I came out of the investment banking side of the business, so you know, you clearly, which I think is an important, the capital flow side of the real estate business is important. You can't forget it. It's what drives your exit values. It often drives your opportunity set, you know, particularly if the capital markets create dislocations that can create opportunity. But you know, depending on where you want to play in the real estate space, I guess the most important advice I'd give is to be continually curious. There's no question that is too small. Don't forget the micro. It's what really drives this business. What's great about this business is it's highly inefficient. It's still primarily traded privately. You know, Manny does his best to make it more efficient, but you know, particularly when I'm buying from him. But it is truly inefficient. It's a street corner by street corner. We've talked a lot about how submarkets are all different, and a lot of the great real estate fortunes were made by guys who knew one or two street corners really well. And you can't forget that. Who's this tenant? You know, it's just, oh, we got a lease. Well, how good's this lease? You know, and who's the tenant? What's behind it? And you know, really just always asking questions. And because in some ways, real estate's a very simple business. Someone once told me if you could divide by 10 and multiply by 10, you knew the spreadsheet side of the business. Even, but it goes obviously, you know, far beyond that, and truly understanding where value is, and don't forget the micro. That's what I'd say.
So a heck of a time to be in the business, right? Great time for young people coming in general.
I think so.
Right. So do we open it up to the audience for questions, Kent? Anybody in the audience has any questions, or? Okay. Well, if not, I've got one other question here for the group, and that is, there is so much talk about investors wanting to be in urban areas, and the suburbs, there's a school of thought that suburbs are dead, and people want walkability, et cetera, and shops, et cetera. So if any of you can give your opinions on the urban versus suburban play from a real estate standpoint going forward. So, Tom, you want to?
Me? Okay. We do like walkable urban. We love mass transit oriented sites. Having said that, in the back of our mind, we're thinking that, you know, the current generation of millennials, and they're going to get older at some point in time, and I don't know exactly what their preferences are going to be 10 years from now. So I don't think the suburbs are dead forever. I mean, eventually these you know, tenants are going to have kids, and it might not be an ideal situation. So I don't think anything is going to be completely dead. But having said that, really well located, you know, dense urban housing with transportation linkages, you know, is something that is attractive, and I think it's here to stay. I just don't think it's the only thing.
Anybody else?
I'd agree with that. I think it's real. We're seeing it everywhere. It's across all age groups. I mean, saw a stat yesterday that the percentage of under 24 folks with driver's licenses dropping dramatically. Obviously, the baby boomer generation, I know if I ever retire, my wife won't let me go unless anywhere that a Starbucks isn't within a 10-minute walk. So, you know, it's an important dynamic. We're seeing it in our home builder. We're focusing on urban infill, on townhomes are becoming a much bigger part of the space. But I'd also agree that I don't think the suburbs are dead. I mean, we're seeing some of these dynamics, frankly, in the suburbs, where you're seeing lifestyle centers. You know, it's obviously food and entertainment is becoming a big part of all developments, whether they're you know, suburban or urban. And I think that sort of, you know, maybe the kitchens are what's dying and not the suburbs. But we think it's real.
Okay. Last question. Peter Linneman at an earlier presentation said that interest rates are unsustainable at the low levels they are today. And so what are your thoughts? Are you concerned about move up in rates? And if you are, what are you doing about it, or in terms of your investment strategy?
I can answer that one. We are nervous about a move up in rates, and we've had heightened focus on refinance rates on the mortgage loans we do. Probably the one thing that is most disturbing in an increasingly competitive lending environment is the willingness of lenders to go to more interest only at higher proceeds, and that scares the hell out of me.
That's what I would echo that big time. Over the last 12 months in CMBS, interest only's crept in, so that's sort of a natural amortization, particularly with rates as low as they are. Amortization is much more powerful with a low interest rate environment. So as opposed to an interest rate in the 6 or 7% range on a 30-year AM and a 10-year term, you amortize sort of high teens. You get into the 5 or sub-5 interest rate range, the 30-year AM at the end of year 10, you're into the 20s in terms of what you've amortized. So the effective leverage point at maturity is a much more palatable level. The other thing that's come out of the recession for CMBS is the concept of debt yield or a break-even cap rate, as we like to call it. So you have a little bit of a check where you can't fall into the, you know, it's 125 coverage, never mind what the rate is, you have coverage. Well, if that's a, you know, a 7 debt yield, that may be an unsustainable kind of cap rate to get out of this thing, particularly if you're, you know, trying to reduce the amortization.
Any other wisdom on interest rates from that end? Going up or down?
I don't think they have a choice at this point.
Okay.
It's just when.
All
But
right.
yeah, we haven't necessarily, or it's definitely been discussed on multiple levels, but we haven't really changed our underwriting with a thought that, you know, 6 months from now, and we're also variable rate lenders for the most part, so it's a little bit different, and we're usually a shorter term. So, that's definitely a discussion.
Okay, great.
So.
I think we're holding up the cocktail party. If there's no other questions, people might start throwing things at us. So with that, I guess we conclude. Thank you.
Well, let me take this. The cocktails will be served in the Regency Rotunda. As you leave the room, head to the right, and at the end of the hallway, there's a sign. Head left all the way down into the large rotunda area.